What if I told you the recession itself isn't what's going to cost you the most money? For most people, the real financial damage, the kind that can wipe out a decade of hard earned savings, happens in the weeks and months before the crash. It starts when the headlines get scary, the market feels a little shaky, and that knot of fear starts tightening in your stomach. It's not the economic downturn that empties a portfolio. It's the handful of predictable, emotional choices we make just before it. These mistakes feel so rational in the moment. They feel like you're finally taking control, protecting yourself from the storm everyone sees coming. But in reality, they're financial traps. It all boils down to 5 mistakes, all driven by fear. These are the very missteps that separate people who lose big from those who navigate the chaos and even come out ahead. In this video, I'm going to break down exactly what those 5 mistakes are. But more importantly, I'll show you how a few simple shifts in your thinking can be the difference between catastrophic loss and protecting your wealth for the long haul. This isn't about timing the market or using some risky, complicated strategy. It's about understanding your own psychology and having a plan to counter it. So, let's get into it. Recessions are a normal, if unpredictable, part of the economic cycle. They can be sparked by anything from a banking crisis to a global pandemic. And while economists love to argue about the timing, the warning signs often start to flash months in advance. We see consumer confidence start to dip, and we hear whispers from the big banks saying, "Yeah, the odds of a downturn are going up." This is the danger zone. It's that period of maximum uncertainty where fortunes are lost before a recession is even officially on the books. The good news? These mistakes are completely avoidable because they follow a pattern. Once you see it, you can't unsee it. Every recession looks different, but human behavior is the same. Panic, sell, chase safety, then miss the rebound. Today, we're going through the 5 most destructive mistakes people make, and I'll give you a clear, actionable plan for each. Mistake number 1, the news trap. The first mistake, and honestly the most powerful one, is what I call the news trap. Freaking out over headlines. Before a recession really gets going, the media machine kicks into high gear. YouTube thumbnails with red arrows, news channels with scary countdown clocks, and so-called gurus predicting financial Armageddon. It all creates an echo chamber of fear, and your gut instinct is to do something. The problem: why reacting to news is a losing game. Here's the deal. The news tells you what already happened, not what's going to happen. The stock market is a forward-looking machine. By the time a scary headline hits your phone, institutional investors and their algorithms have already priced it in. We saw this in March 2020. As news of lockdowns took over, countless investors dumped their stocks, thinking they were getting out before a total meltdown. But the market had already bottomed out. They locked in massive losses and watched from the sidelines as the market went on an incredible tear. The media's job is to get your eyeballs, and fear sells. The solution: focus on signals, not noise. You avoid this trap by having an investment plan you wrote before the panic. You need to know what you own, why you own it, and the specific reasons you would sell. This plan is your anchor in a sea of fear. It forces you to act based on your own rules, not on gut reactions to someone else's scary headline. Instead of reacting to media noise, you learn to pay attention to the boring but important signals the pros watch, like credit spreads and the yield curve. You don't have to become an economist, but you must have a plan. Mistake number 2, the permanence trap. This leads right to the second big mistake, the permanence trap. This is when you panic sell your best assets, turning a temporary paper loss into a permanent one. When the market starts dropping and you see your portfolio value shrink, it's tempting to just sell everything and run to the safety of cash. You feel like you're stopping the bleeding, but what you're really doing is making one of the most destructive mistakes an investor can make. The problem: turning paper losses into real-world losses. When you sell a quality asset in a downturn, you lock in that loss forever. Think about it. If you own an index fund or a great company, its stock price might drop 30% because of market-wide panic. But did the business itself just become 30% worse overnight? Did its biggest competitive advantage vanish? Almost always the answer is no. The price dropped, but the underlying value is still there. By selling, you lose any chance for that asset to recover. Panic destroys far more wealth than recessions ever do. Crises are temporary. Quality is not. The solution: analyze the asset, not just the price. To avoid this, you have to separate an asset's price from its value. Before you hit that sell button, ask yourself one simple question. Is the business broken, or is just the stock price broken? If you owned a profitable local coffee shop and property values in town dropped 20%, you wouldn't immediately sell your shop at a discount. You'd ride it out. Treat your high-quality stocks the same way. Recessions are the stock market's version of a Black Friday sale. Smart investors are calmly walking in with a shopping list while everyone else stampedes for the exits. Mistake number 3, the leverage trap. As the economy slows, central banks often lower interest rates to get things moving. To many people, this looks like a golden opportunity. That car loan is more affordable. That home renovation seems doable. This leads to the third catastrophic mistake, the leverage trap, which is taking on new, often risky debt right when your own income is most fragile. The problem: when cheap money becomes a chain. The idea of cheap money is a dangerous illusion before a recession. While the interest rate might be low, the risk of having that debt is at an all-time high. Why? Because recessions mean job losses, reduced hours, and smaller paychecks. The very income you're counting on to pay that new debt is suddenly in jeopardy. This is what happened before 2008, when millions were sold on adjustable rate mortgages with low teaser rates. It felt like free money, but when the economy tanked and rates shot up, they were trapped. Debt feels like a superpower on the way up, but it becomes a set of chains on the way down. The solution: fortify your balance sheet before the storm. The time to prepare is before the storm hits. Instead of looking for new ways to borrow, you should be making yourself financially bulletproof. Your first priority is to aggressively pay down high-interest debt like credit cards. Second, beef up your emergency fund. Aim for 6 to 12 months of living expenses. This cash is what allows you to ride out an income shock without being forced to sell your investments at the worst possible time. Before you take on any new payment, ask yourself, if my income got cut by 30% tomorrow, could I still handle this? If the answer is no, you can't afford it. Mistake number 4, the yield trap. As high-flying stocks start to stumble, nervous investors get desperate for something else: income. This brings us to mistake number 4, the yield trap. This is when people flock to anything that promises a high, steady payout. Stocks with huge dividends or risky corporate bonds. It feels like a smart, defensive move. But right before a recession, it's often the riskiest thing you can do. The problem: a high yield is a warning, not a guarantee. In investing, there's no free lunch. A super high yield is almost always a signal of super high risk. The market is telling you there's a real chance that the income you're being promised could be cut, or that the investment's price could crater. In 2008, investors who had piled into high-yield junk bonds for their juicy income saw them completely collapse. The companies offering the highest yields are often the ones in the most financial trouble. During a recession, the money you lose when these assets fail is almost always far more than you ever earned in income. The solution: prioritize a strong business over a big payout. Stop seeing yield as the goal. Instead, see it as a nice byproduct of owning a healthy, high-quality business. A company with a long history of consistently increasing its dividend, even if the current yield is just okay, is a much safer bet than a company with a high but shaky one. A history of dividend growth is a powerful sign of a well-run business that can keep paying you through a downturn. Real security comes from the quality of what you own, not from the siren song of a payout that can't last. Mistake number 5, the cash trap. This is the final and perhaps most subtle mistake. After getting slammed with negative headlines, many investors make what they think is the ultimate safe move. They sell everything and go 100% to cash, waiting for certainty. This is the cash trap, and it can do just as much long-term damage as panic selling. The problem: the twin killers of inflation and missed recoveries. Sitting in cash exposes you to two silent portfolio killers. First, inflation is constantly eating away at your money's value. Holding cash doesn't preserve your wealth. It guarantees a slow but certain loss of purchasing power. Second, and even more damaging, is the cost of missing the market's recovery. Market bottoms happen when fear is at its peak and the news is terrible. They are almost always followed by sharp, sudden rebounds that occur long before the economy feels better. If you wait for certainty, you will miss the best days. Research from JP Morgan has shown that if you missed just the 10 best days in the market over a 20-year period, your total returns would be cut by more than half. The solution: use cash as a tool, not a destination. The right way to think about cash is not as a permanent hiding spot, but as a strategic tool. It has two jobs: your emergency fund and your opportunity fund, to use when great assets go on sale. Instead of trying to time the bottom, commit to dollar cost averaging, investing a set amount at regular intervals. This is an automatic, unemotional system that forces you to buy low. Have a buy list of high-quality assets you'd love to own at a discount. When the market panics and hits your price, you don't have to think. You just execute the plan you already made. All right, let's quickly recap the 5 traps that kill your wealth before a recession even starts. The news trap: making emotional trades based on scary news that the market has already priced in. The permanence trap: turning temporary paper losses into permanent ones by dumping your best investments. The leverage trap: getting tempted by cheap loans right when your income is most vulnerable. The yield trap: jumping into risky, high payout assets that are often the first to blow up in a crisis. The cash trap: hiding on the sidelines, letting inflation eat your savings, and missing the inevitable market recovery. Your 5 recession rules. So here's what you do instead. These are your 5 simple rules for a recession. Your emergency fund stays. Your automatic investing, DCA, stays. Your quality assets stay. Your high interest debt goes down. Your spare cash gets a job on your buy list. Navigating the days before a recession isn't about being a financial genius. It's about mastering your own emotions. The market is unpredictable, but how we react to fear is incredibly predictable. Every one of these 5 mistakes is born from that feeling of uncertainty. By understanding these traps, you can flip the script. You can use volatility not as a threat, but as the very opportunity that great long-term investors wait for. The key is to have your plan written down before the storm hits. Know your rules, know why you own what you own, and build the financial strength to stick to your plan when it feels hardest. Recessions aren't the end of the world. By avoiding these 5 mistakes, you can ensure you're not a casualty of the next downturn, but someone who is ready to come out the other side stronger than before.